In 2014, a 400-acre cornfield north of Omaha was worth 5 times what it cost 28 years earlier. Its owner had visited it twice. He never planted it, never drove the combine, never checked grain futures at midnight. He let his son run it and collected a rent check every year. The owner was Warren Buffett, the man most of Wall Street treats as the patron saint of stock picking. And by his own account in his 2013 letter to Berkshire Hathaway shareholders, the asset that quietly tripled its earnings without a single dramatic headline wasn't a stock. It was dirt. You already know what the average investor does with a windfall. Open a brokerage account, buy an index fund, maybe a few individual names someone mentioned on a podcast. Watch the number go up and down every day the market is open. Feel something close to dread every time a headline uses the word correction. Quiet money does something else. It buys ground. Then it stops looking at the price. Buffett's farm purchase is useful precisely because it isn't a secret. He told the story himself, in public, in writing, to anyone who reads Berkshire's annual letter. He bought the 400 acres from the FDIC in 1986 after the 1980s farmland bubble collapsed and land prices across the Midwest fell by more than half. He paid $280,000. He didn't know how to farm. He asked his son Howard, who did, to estimate the yield and the costs. The math worked. He bought it and walked away. What he said next is the part most viewers skip past. He compared the farm to a hypothetical neighbor who shouts a different price for the property every single day, sometimes wildly high, sometimes absurdly low, depending on his mood. Buffett's point wasn't about farming. It was about what happens to your judgment when an asset has a price ticker attached to it versus when it doesn't. The farm had no ticker. Nobody texted him its valuation every afternoon. He couldn't panic sell it during a bad news cycle because there was no app open at 2 a.m. to do it from. The absence of a quote was the asset's real advantage. This is the part that gets lost in most financial content. Stocks aren't risky because companies are fragile. Most large public companies survive market crashes just fine. Stocks are risky because they're priced every 6 seconds, and a price that updates every 6 seconds gives a frightened person 6 seconds, repeated infinitely, to make a bad decision. Land doesn't extend you that opportunity. You'd have to call a realtor, get an appraisal, find a buyer, and wait weeks. By the time you could sell out of panic, the panic has usually passed. Compare 2 people who each had $280,000 to invest in 1986. One bought the S&P 500. The other, like Buffett, bought farmland. The stock investor lived through the 1987 crash, the dot-com collapse in 2000, the 2008 financial crisis, and the 2020 pandemic crash, 4 separate events where the value of the holding fell by 30% or more within months. Through every one of those, the number on the statement told them, in real time, exactly how much poorer they'd just become. The farmland investor watched corn prices and rental income shift gradually, year over year, with no single day capable of cutting the value in half before lunch. The data backs this up in a way that has nothing to do with nostalgia for the family farm. The NCR-EIF Farmland Index, the industry benchmark that has tracked institutional-grade U.S. farmland since 1990, shows average annual returns of roughly 10% since the early 1990s, with annual volatility around 6 to 7%. The S&P 500 over a comparable stretch has returned a similar headline number, somewhere around 10% annually, but with volatility closer to 17%. Same return. Less than half the stomach churning. That isn't a folk theory passed down at a dinner table. It's a measured, appraisal-based index used by pension funds to decide where to park retirement money for millions of teachers and firefighters. Here's where the contrast sharpens. The average investor chases the higher number. Old money chases the lower variance. Those are not the same goal, and confusing them is where most retail portfolios go wrong. A 10% return that swings wildly every year is a different financial product than a 10% return that creeps forward steadily, even if the long-run arithmetic looks identical on a spreadsheet. The first one tests your nerve. The second one tests your patience. Patience is teachable. Nerve under real financial pressure mostly isn't. Land has carried this reputation for longer than American finance has existed. For centuries, the English landed gentry organized entire estates around a single rule. The land does not get divided, sold, or mortgaged away from the family line. Primogeniture wasn't sentimentality. It was a financial control system. A single heir inherits the whole estate intact, rather than a portfolio of grandchildren, each holding a sellable fraction, because sellable fractions get sold, especially during a crisis, especially by an heir who never knew the original owner and feels none of the weight of holding it. The asset survives generations specifically because it's hard to liquidate. The difficulty is the feature, not the flaw. The same pattern shows up on the other side of the Atlantic, just later, and with different paperwork. American fortunes built on railroads, lumber, and oil in the 19th century followed a similar instinct once the original business matured. Acreage accumulated as collateral or speculation in one generation became the quiet core holding of the next. By the time the railroad stopped expanding and the oil fields stopped gushing, the land underneath both of them was still there, still producing rent, still nobody's headline. That habit never went away. It just moved upstream into institutions that manage money on behalf of people who will never see the deed. University endowments, the ones that fund scholarships and faculty salaries for decades at a stretch, have held farmland and timberland for years as part of a broader allocation to what the industry calls real assets. Pension funds do the same thing for an even simpler reason. A pension has to pay out a fixed amount every month for 40 years. And a fixed monthly obligation is far easier to meet with an asset that produces steady rent than with one that might be down 25% the week the check is due. Nobody at these institutions is buying farmland because it's exciting. They're buying it because the actuaries ran the numbers and stocks alone couldn't guarantee the payout. Here's a second comparison, smaller in scale but just as telling. Picture two neighbors in rural Illinois in the early 1980s, each holding $50,000 in spare cash after a good harvest. One puts it into mutual funds, following the advice in the financial magazines of the era. The other buys an adjoining 80 acres because an older relative once told him, land is the one thing that's never made anybody poor who held on to it. Over the next decade, the mutual fund investor lives through 1987's single-day 22% crash, a number that, even adjusted for time, still ranks as one of the worst trading days in American history. The neighbor with the 80 acres reads about it in the newspaper 2 days late, because he was busy with the harvest, and the value of his land hasn't moved by more than a rounding error. 40 years later, one of those two men can point to a specific gate, a specific fence line, a specific stand of trees, and say, that's mine, my father's before me, and it has paid for 3 sets of college tuition without ever once being sold. The other has a brokerage statement with a number on it that has, in absolute terms, also grown. But there is no fence line. There is no stand of trees. There is only a balance that resets to zero in his attention every time the market dips and the financial news anchors start using the word sell-off. That difference between an asset you can point to and an asset that only exists as a number on a screen is not a small one. It changes how a family talks about money across generations. A stock portfolio gets explained to children in abstractions: shares, tickers, diversification. A piece of land gets explained by walking it. You can show a 14-year-old where the creek floods in spring, where the soil drains badly, where the previous owner planted the wrong crop and lost 2 seasons learning from it. The lesson sticks differently when it's attached to a place instead of a percentage. None of this means stocks are worthless. Buffett himself, in the same body of writing where he tells the farm story, has repeatedly told ordinary investors to put the bulk of their savings in a low-cost S&P 500 index fund, including in instructions he left for his own wife's trust. The contradiction is only apparent. Stocks are an excellent way to own a piece of the world's productive. Businesses, and for most people without significant capital, they remain the most accessible path to building wealth at all. Stocks are a poor place, however, to put money you cannot afford to watch lose 30% of its value on a screen without doing something rash. Land for those who can afford the liquidity and the upfront capital solves a problem that has nothing to do with expected return and everything to do with behavior. It removes the daily decision entirely. That's the actual mechanism behind they never sell. It isn't loyalty to the soil, it's structural. You cannot sell what takes 6 weeks in a title search to liquidate as easily as you can sell what takes 4 seconds and a tap on a phone. Old money didn't discover a magic asset class that outperforms everything else. It discovered, generations before behavioral economics had a name for it, that the easiest way to stop a human being from making a panicked decision is to make the decision inconvenient to execute. There's a quieter benefit too, one that almost never makes it into the pitch. Land doesn't show up on a public exchange with a QZIP number that anyone with a brokerage login can search. A stock portfolio, once it's large enough, becomes visible the moment it triggers a regulatory filing. A farm doesn't trigger anything. It sits in county property records under whatever name a trust or an LLC chooses to use, and almost nobody outside the family ever has reason to look. For families thinking in terms of decades rather than quarters, that low profile is its own form of protection. Visible wealth invites attention. Attention invites lawsuits, solicitations, and relatives who reappear only when there's something to ask for. Quiet wealth mostly just gets left alone. If you're looking for the takeaway, here it is, stripped of the romance. The wealthiest, most durable family portfolios aren't durable because they picked better investments than everyone else. They're durable because at least part of the portfolio is built to be hard to touch. A cornfield that took 6 weeks to sell in 1986 is still, in a meaningful sense, the same cornfield today. Dull, slow, untouched by Tuesday's headlines, and worth 5 times what it cost the man who never bothered to learn how to farm it. That's the whole strategy. Not a secret formula. Not a hidden account. Just an asset slow enough that nobody, not even its owner, can ruin it in a panic.